Hello listeners, welcome back to our channel Vishwakul. Here we will be telling you the news going around the world and also what's currently the situation in the Indian market. Now, to start with the foreign investors, we can see that the 80,000 rupees has been evaded from the market. Yes, exactly. 82,000 crore has gone, and we need to see over here why the foreign investors are ditching the Indian markets. So, to start with the foreign investors, why they are leaving the market, we need to know the certain things which affect our market situations. In October 2024, the Indian stock market saw one of the largest sell-offs by foreign institutional investors in recent history. Foreign institutional investors sold a massive 82,000 crores, about $10 billion in just a single month. This outflow of foreign money has even surpassed the previous record of around 58,000 crores that FII withdrew during the COVID-19 pandemic in March 2020. So, in this story today, let's understand why this happened and what it means for us as the investors and those who keep an eye on the markets. Before diving into the details, let's first clarify who FII are. For those who may not be familiar, simply put, FII or foreign institutional investors. They are the large financial institutions from other countries. These include the hedge funds, pension funds, or asset management companies that invest significant amounts of money in the countries like India. They move their money across the global markets, looking for the best returns. When foreign institutional investors buy stock in a country, they can have a big impact on the market. There's also a sentiment aspect to this. When foreign institutional investors buy or sell in large quantities, other investors often see it as a signal, influencing their own decisions. We believe this is what has happened in the October 2024. For example, whenever you see that many of the sellers are selling a particular commodity, this is a basically sign that the prices are already down and they would be further moving more down. So this is a signal that the buyers would not be interested to buy it. The same situation is going on with the Indian market. When the foreign institutional investors are selling the Indian shares, this is a signal for the other sellers that they should also sell it and they should move for the different opportunity. The reason this sell-off is such a hot topic is that it comes as a bit of a surprise. Earlier this year, foreign institutional investors were buying the Indian stocks, helping drive a market rally. But now they seem to be doing the opposite. Of course, no one can say for sure why foreign institutional investors are selling or why the markets are falling. But we can make a reasonable guess. Most analysts attribute this foreign institutional investors sell-off to four main reasons. The first reason for it is the valuation concerns. Indian stocks have become quite expensive compared to other markets. For example, the Nifty 50 has a price to earning ratio of 23x. In simple terms, this means investors are paying 23 times the earning of these companies, which is higher than what we have seen in the recent years. Valuations in the mid caps and small caps are also on the higher side. Meanwhile, markets like China are currently offering stocks at much cheaper valuations, making India less attractive to foreign investors looking for the best returns. Now, second point is the shift to China. China has introduced significant stimulus measures to boost its economy, making it an appealing option for global investors. This has led to a sell India, buy China. Exactly. This is the notion going on, sell Indian stocks and buy China stocks. Trend as investors move their funds where they see more opportunities, which we can say in economics is the term hot money. Whenever the investors see that they are getting a good amount of interest, they move their money in those areas. The same is going on with the India when people are selling the Indian shares and buying the China shares. Third reason is the global economic factors. Despite the recent 0.5% rate cut by the Federal Reserve and expectations of more cuts, the yield on the 10-year US Treasury bond has increased from about 3.6% to 4.2%. Why? One reason could be that traders were too optimistic about aggressive future rates cuts by the Fed and now are adjusting their expectations. Or it could be that the market believes we are unlikely to return to the pre-pandemic world of zero interest rates, making this a shallow rate cut cycle. The next reason is the bonds and stocks. Bonds and stocks often compete for investment dollar. As bond yields rise, the appeal of investing in equity decreases, as investors can achieve better returns with lower risk by choosing the bonds. Because whenever you are buying the bonds, basically you are lending the money and you would be earning a shortcut interest on the bonds. as compared to the equity where you do not earn the interest. So this is the benefit which has been driving the rise of the bonds continuously and the selling of the shares. Now, the next point which we can see is basically that how the people are choosing more of the bonds. This shift might be causing foreign institutional investors to move their money out of Indian markets and reallocate it to the US. A stronger dollar is also a factor. After a period of decline, the US dollar has rising alongside US bond yields. Now the next point, the reason for the foreign institutional investors selling our shares are disappointing corporate earnings. Some key sectors in India, like consumer finance and energy, have reported weaker than expected earnings this time. This may have damped investors' confidence, adding to the reason why foreign institutional investors are withdrawing their funds. Many brokerages have been lowering their earning growth estimates for the Nifty, expecting growth between 4 to 7%, which is a multi-year low. This wave of selling has had a noticeable impact on the Indian stock market. The BSE 500 index, which tracks the performance of 500 top companies in India, has dropped by about 7% from its peak. Sectors like consumer finance, fast-moving consumer goods, FMCG, and energy have been hit the hardest, since these are areas where foreign institutional investors had significant investments. But despite the heavy selling by foreign investors, the Indian market hasn't collapsed. If you are wondering why, it's because the domestic institutional investors come into the picture. Exactly. Whenever the foreign institutional investors are selling, there is someone who is buying those shares. And this is the domestic institutional investors, which include the mutual funds, insurance companies, and pension funds. They have stepped in to buy shares. In October 2024, domestic institutional investors purchased stocks worth 83,271 crore rupees, more than covering the amount sold by foreign institutional investors. More they are buying, the less favorable is the market will fall further. This strong domestic buying has helped stabilize the market, and also it has prevented a major downturn. Retail investors who invest through the SIP, systematic investment plans, have also played a key role over here. Systematic investment plans have been steadily growing, averaging around 22,321 crore rupees per month has been investing in these systematic investment plans regularly. This shows that domestic investors still believe in the long-term potential of the Indian market, even though foreign institutional investors are pulling out their money. Despite the current sell-off, many analysts remain optimistic about the India's long-term growth story. Yes, this is something interesting. Even though the foreign institutional investors are selling, but still the domestic institutional investors are sure that the market would be rising. And this is the reason why we can see that in India, the systematic investment plan has been going on and the people are continuously investing in the Indian market. The fact that domestic investors are buying during this period of foreign selling reflects strong confidence in the India's future, where we can predict the India's long-term growth would not be dented because of the foreign institutional investors. Also, the government initiatives like the Production Linked Incentive (PLI) scheme are expected to further boost the economy, potentially making India an attractive destination for the investments over time. Looking back at history, the Indian stock market has bounced back from the large foreign institutional investors' sell-offs before. For example, after the global financial crisis in 2008, the market fell sharply by a lot of percentage, but it had recovered by over 127% within just 12 months. Similarly, after the COVID-19 crash in 2020, the market rallied significantly. So yes, we can see over here that even though the foreign institutional investors are continuously selling off the Indian shares because of the reason buy the China company shares and sell the Indian company shares, still the domestic institutional investors are confident about the Indian market. And also the valuation concerns which we can see in the Indian market, where the prices of the shares in the Indian market is continuously basically over leverage, or we can say that the price earning ratio is running on 23x, which is not according to the data, or it should be concerned for the foreign institutional investors as well as for the domestic institutional investors. But the last thing which we can see over here is the Indian market may remain volatile in the short term. The outlook for the long term is more hopeful, with expectations for a recovery down the line. We have discussed what's driving foreign investment flow out of India with the other persons also, and the investors are confident that yes, the Indian market would rise. So yes, we can see over here that even though the foreign institutional investors are selling off the Indian market shares, the domestic institutional investors and the systematic investment plans by the consumers would make the market go for further growth. If you have liked our video, Do share this video with your friends, like our video, and also subscribe to our channel for more such interesting facts. Thank you.